Hi there, and welcome to the Mint Asset Management Fund update for the month of January. I'm John Middleton, and I'll talk you through the returns of the funds. So just a little bit of market drivers and macro to start with. I've put a couple of earnings worm charts up just to highlight a few things. I mean, first of all, in general, market expectations start with about 10% growth at the beginning of the year, which generally gets reined into about 5%. And that's been sort of the sequence over most years, albeit sometimes we exceed expectations. Looking more recently, certainly the last few years, the growth expectations and delivery have been pretty subdued. Certainly the last couple of years has been a bit weak. And the point I'd make ahead of reporting season is we are going into results season expecting negative growth of about 4% for the year. So expectations are low. And again, I think we will have a subdued reporting season. The interesting thing I would note is I'm probably more concerned about FY26 than FY25. The reality is we're currently looking at 15% earnings growth expected for FY26. Okay, it's helped on the sort of the weighted average earnings growth by Fisher & Paykel Healthcare, which is expected to give us 20% growth. But the medium of about 15% for 2026 still feels pretty high. And I think we would expect that to be reined in going forward. Moving across to the funds, starting with the SRI fund. I suppose there were three key themes that really impacted the New Zealand market during the period. First of all, index changes. Basically, there's an expectation that Mercury is to be cut from the MSCI and replaced by Contact, which has driven quite sort of significant volumes during the month. Essentially getting the announcement of this change or expected change on the 12th of February, and the rebalance happens on the 28th. The point I'd make there is it looks like half the potential selling volume of Mercury has already been traded and is now in the short position. Secondly, tariffs. China, Mexico, and Canada were clearly the focus, and for the New Zealand market, that really takes in Fisher & Paykel into account, basically because they manufacture 45% of their volumes out of Mexico and then send the majority of that to the States. Obviously, FBH was weighed down a little bit by that Trump tariff threat. Remains to be seen whether it's going to be enacted, and certainly last time around it wasn't. But I think from the tariff perspective, Fisher & Paykel is probably the one you are most worried about in the New Zealand market. And then finally, DeepSeek, essentially a Chinese variant of AI, which uses a lot less compute to deliver the same compute capacity as much more sophisticated Western NVIDIA-powered data centers. So sort of raising the question whether we need all the sort of AI-focused compute, data centers, et cetera, that we've been thinking about, and that weighed on a number of stocks within the market, but particularly on Infratil, which has both data centers through CDC and also sort of green energy, which is a secondary issue. Which again, Trump was sort of the questions whether we need the same amount of energy to do the same compute. The reality is we're reasonably comfortable with Infratil. I mean, it's had a very good run and looked after us very well over the last couple of years. The reality is they invested in these trends probably 5 years before people saw them coming, and have done very well out of them. I think when you look at the market's response to DeepSeek and what it's done, clearly it's affected Infratil, and that was the main driver of the performance in New Zealand and in the fund in the period. But I do think the market's slightly missing the point there. The reality is I think this different way of using chips and data centers to create some compute energy is essentially just a better, cheaper way of using the resources, and should lead to a much broader and deeper, use of AI in the future, rather than precluding it. And hence, we remain pretty comfortable with Infratil over the medium term. Moving across to the Australasian Fund, again, a solid performance for the period, slightly ahead of benchmark. Yes, Infratil weighed a little bit, as did Aroa, which delivered another decent set of results, but unfortunately they mismanaged expectations. So, strong results and a break even in terms of EBITDA was construed as a negative and weighed on the share price. Aside from that, actually, we had a pretty decent period. And again, we recovered some of the weaker performance out of the Australian names in January. And as I said, slightly outperformed the benchmark. Standout was Telex again. And we've talked about that a few times, but we still think there's a number of catalysts over the year ahead which will expand their portfolio of radiomedicine and potentially bring the prospect of therapeutics closer. So pretty happy to stick with that one. But also we got some benefit out of Megaport, WiseTech and James Hardie, all giving a positive return in the period. And we actually took a little bit of profit out of those names. I'd also flag the bounce in EBOS, and we've sort of had a decent position in that stock for a while. There have been concerns about the impact of losing the Chemist Warehouse contract, and I think further conversations with management have focused the attention on what the downside risk would be, about 70 million of EBITDA, and to be honest, that's a pretty good result. And hopefully we start looking forward into the medium-term prospects of the business, which were helped by the 8th community pharmacy agreement, which again is giving further funding to the sector and should help that business to continue to grow, well over the medium term. For completeness, we've added actually an earnings worm for the Australian market as well. Quite similar parallels with New Zealand, albeit, we have had a couple of periods of particularly strong growth, largely driven by the resources sectors over the sort of 2000s or 2020s. But if you look at the FY25 outlook, it's actually pretty similar to New Zealand with negative growth expected, so reasonably low expectations. And again, in contrast to the New Zealand comments, I would flag that expectations are about 5% growth out of the Australian market in FY26. So certainly more conservative or more realistic than in New Zealand at this point in time. And particularly when you dig into the makeup of that growth, essentially the bank sector has got negative growth of about 2.1%. It's actually limited resources growth at 3.2%. And so the majority of that growth to get to 5% is actually delivered by the industrial sector, which is quite a broad sector, including things like healthcare industrials and other bits and bobs. But, that's expected to deliver 12.5%. And I think, within that area, there are a number of quite interesting companies to take a look at. Within the fund, again, we took a little bit of profit out of the Aussie side of things and added a couple of names back into the portfolio, SRG being one, and also we bought a bit of Fletcher Building ahead of their results. And finally, moving across to the property fund, again, a solid performance in the period, slightly ahead of benchmark. Again, a similar theme to the Australasian Fund, a little bit of a bounce back in some of the Aussie names which were hit in January. In December in particular. Charter Hall had a much better month. If we look at the positioning in the fund, Goodman Group was a stock which was impacted by the AI concerns similar to Infratil, which again we think are overdone. So we bought back a bit of that, added to our position, and also we added to our position in Channel Infrastructure. I thought the chart on the right was relatively interesting. Again, this is CBRE data about vacancy in New Zealand. The interesting thing is that over 2024 and 2025, we have seen a slight deterioration in particularly B-grade office in Auckland, and a bit of mounting pressure in particularly the A grade of office in Wellington, where vacancies have started to rise. I think the good news for the sector is, the vast majority of the assets are focused on prime or premium grade assets. So it's only the smaller companies which probably are feeling that vacancy hit and leave earnings relatively resilient. We do have a mini reporting season in February. We've got Precinct, Vital Healthcare, PFI and Winton all reporting. And again, to that thing, we're not expecting huge revelations with results. I think it will be a solid rental performance with a bit of an interest rate headwind, leaving basically earnings looking pedestrian and broadly flat. I suppose that the key thing of interest for the property sector and the wider market will be the RBA's interest rate decision, sorry, RBNZ's interest rate decision on the 19th of February. We're expecting a 50 basis point cut to rates, which should give the property sector a bit of a catalyst and help the general market. And clearly, if it's less than that, I think that will go down badly. Anyway, I hope that was of interest. As usual, if you do have any questions, please drop us a line at info@mintasset.co.nz or give us a call on 0800 464 833. Thank you for your support, and we look forward to speaking to you in a month's time in early March, when the reporting season will be largely over.